Imagine for a moment that you're living in Canada, right?
hmm
You're meticulously building your wealth, doing everything by the book.
Yeah, maxing out the accounts, being responsible.
Exactly. You've got your tax-advantaged accounts all maxed out, your portfolio is broadly diversified, and you honestly feel like, hey, I am winning the financial game here.
You feel like the master of your own financial destiny.
You really do. But then the U.S. Internal Revenue Service, the IRS,
Yeah.
enters the chat, and suddenly the rules of the entire game just completely flip.
Oh, it is quite the plot twist. I mean, you go from feeling like this incredibly savvy investor to suddenly realizing you're walking through a financial minefield
Yeah.
and you don't even have a map.
Right. What works perfectly in the Canadian system can suddenly trigger these massive penalties south of the border.
Absolutely massive.
So today, we are mapping out that exact minefield. Welcome to today's deep dive. We're exploring the incredibly complex and honestly sometimes really perilous financial landscape of being a U.S. citizen or a dual Canada U.S. citizen investing in Canada.
It's a topic that affects so many people, but it's rarely talked about clearly.
Totally. So using comprehensive cross-border tax regulations and materials provided by today's information provider, Lunaris Financial Services, our mission is really simple. We want to act as your financial map, helping you dodge those massive IRS penalties and smoothly transition your portfolio if you're moving toward U.S. citizenship.
That transition period is where the biggest mistakes happen, for sure.
Oh, I bet. Okay, let's unpack this. Before we can even understand how the IRS blows up a Canadian portfolio, we first need to establish what a normal, fully Canadian portfolio even looks like.
Right, the baseline. We need to look at the standard retail accounts and, why these accounts function the way they do in Canada.
Let's talk about the everyday Canadian investing experience. I like to compare the Canadian investment landscape to like a VIP club. So the standard retail account, say a cash or margin account to just buy stocks as your general admission.
General admission, exactly. And the barrier to entry there is pretty straightforward. You just need to reach the age of majority.
Which actually changes depending on your province, right?
Yeah, it does. It's 18 in places like Ontario and Alberta, but you have to wait until you are 19 in British Columbia and Nova Scotia.
Interesting. And then you need a Sandy AN, right?
Right, a valid social insurance number. That's so the brokerage can report your capital gains and dividends to the Canada Revenue Agency.
Okay, so age majority and SIN.
And you must pass KYC. Know your client.
Oh, the identity verification stuff.
Exactly. It's not just annoying paperwork. It's strict anti-money laundering protocol. Financial institutions are legally required to verify who you are and understand your risk tolerance before they let you trade.
Makes sense. So once you clear those hurdles, you get access to the VIP lounge.
The tax-advantaged accounts?
Yeah, you've got the TFSA, the tax-free savings account, available at 18. Any growth inside it is just completely tax-free.
It's a fantastic tool for Canadians.
It really is. Then there's the RRSP, the Registered Retirement Savings Plan. You need previous earned income in Canada for that one, and you have to be under 71.
Right, but it gives you a huge tax deduction today, and the first tax is until you retire.
And we can't forget the new one, the FHSA, the First Home Savings Account,
Yeah.
which basically combines the best features of both to help first-time homebuyers.
So those are the tools in the VIP lounge. But above that, there is an ultra-exclusive rooftop deck.
The private markets.
Yeah, if you want to access private equity, venture capital, hedge funds, or pre-IPO startups, you have to qualify legally as an accredited investor.
And the bouncers for that rooftop deck are pretty strict, right? You can't just ask to be let in.
No, not at all.
Nah.
Because private markets are highly illiquid and risky. Regulators basically want you to mathematically prove that you have the financial stability to absorb a total loss without, ending up destitute.
Wow. So how do you prove that?
You have to pass one of a few strict tests. First, there's an income test. Your individual net income needs to be over $200,000 for the last 2 years, or $300,000 combined with a spouse.
Okay. And if you don't have that kind of cash flow?
Then you face the liquid financial assets test. You need over $1 million in cash or securities. And the key here is that it strictly excludes your real estate.
Oh, interesting. Why exclude real estate?
They want deployable capital.
Yeah.
Having a $1 million house in Toronto doesn't help you if a private equity deal goes to zero. You can't just chop off your kitchen and sell it to cover a margin call.
That's a great point.
Though they do offer a third path, which is the total net assets test. If your total overall net assets are at least $5 million, then you qualify. And that test actually can include your real estate.
Because at $5 million, your foundation is just so solid anyway.
Precisely.
Okay, so we have our baseline. General admission, the VIP lounge with the TFSA and RRSP, and the ultra-exclusive rooftop deck. If these accounts are perfectly legal and enthusiastically encouraged by the CRA, why does adding a U.S. passport to the mix suddenly turn this VIP lounge into an absolute minefield?
What's fascinating here is the underlying philosophy of the U.S. tax code. It is fundamentally different from almost everywhere else on Earth.
How so?
The U.S. taxes its citizens based on citizenship, not on residency. They tax worldwide income.
Wait, regardless of where you live?
Exactly. It dates back to the Civil War, actually. They wanted to tax people who fled the country to avoid the draft. So today, the moment you hold a U.S. passport, the IRS believes it has jurisdiction over your wealth.
Even if you've lived in Toronto your whole life.
Whether you live in Texas, Tokyo, or Toronto, it does not matter.
I have to push back on the absurdity of this. How can one country's tax code just override the laws of another sovereign nation? If I'm living in Canada, putting Canadian dollars into a Canadian FHSA, why does the IRS get a say?
Because you hold their passport. It is the price of U.S. citizenship.
That is wild.
It is. And when you understand that global reach, you realize why the TFSA and the FHSA are what we're calling red light accounts. You have to view these with extreme caution.
Okay, let's break down exactly why, because the TFSA literally has tax-free right there in the name. Are you saying a U.S. citizen actually loses money to U.S. tax prep fees just for trying to save for a home in a Canadian FHSA?
Yes. Because the IRS simply does not recognize their tax-sheltered status.
They just ignore the Canadian rules entirely.
Pretty much. When the IRS looks at a TFSA, they don't see a VIP lounge. They just see an unregistered foreign account. So they strip away all the tax protection.
Meaning any income or dividends or capital gains you earn inside a TFSA or FHSA has to be reported on your U.S. Form 1040. And they tax it annually.
Annually, yeah.
But wait, usually aren't there foreign tax credits to stop double taxation? Like, if I pay tax in Canada, the U.S. gives me a credit.
Yes, normally you'd use a foreign tax credit, but think about it, because Canada doesn't tax the TFSA, you don't generate any Canadian tax receipt to show the IRS.
Oh man. So you have zero credits to offset what you owe the U.S. government.
None. You just pay the U.S. tax out of pocket. Plus, as you mentioned, the prep fees. You have to pay a specialized cross-border accountant to file the extra paperwork.
Which probably costs more than the tax itself for a lot of people.
Oh, easily. And we haven't even touched on the darkest corner of this minefield.
There's something worse.
The PFIC trap.
PFIC, Passive Foreign Investment Company.
That's the one.
See, whenever I hear passive foreign investment company, I immediately picture like some shady offshore shell company in the Cayman Islands used by billionaires to hide yacht money.
And historically, you wouldn't be wrong. The PFIC rules were drafted back in the 1980s specifically to stop ultra-rich Americans from hoarding wealth in offshore mutual funds.
Okay, so how does that hurt an average listener in Canada?
Because they cast the net incredibly wide. Under IRS rules, almost all standard Canadian mutual funds and ETFs, like the ones trading on the Toronto Stock Exchange, are legally classified as PFICs.
Wait. Are you saying if I buy a completely boring vanilla ETF that just tracks the Canadian market and I hold it in my TFSA, the IRS treats it like a toxic offshore tax evasion scheme?
Yes, they do.
That is mind-blowing.
And the mechanism of the penalty is designed to be intentionally punitive. If you hold a Canadian ETF in these accounts, the IRS hits you with compounding interest penalties.
Compounding penalties.
Yeah, and they tax your returns at the highest ordinary income tax rates, not the favorable long-term capital gains rates.
How do they even track the math on that? It sounds so complicated.
Through a lovely piece of paperwork called Form 8621, this is where the financial pain becomes very real.
I'm bracing myself.
It is a labyrinth of complex historical accounting. You have to file a separate form for every single fund you own every single year.
Oh, come on. Every single fund.
Every single fund. And specialized cross-border accountants might charge anywhere from $200 to $400 per form per fund per year just to run the calculations.
So if you have a beautifully diversified portfolio with like 5 different Canadian ETFs, you are spending thousands of dollars just on tax compliance.
Exactly, before you even pay the actual punitive tax. Plus, they might also require Forms 3520 and 3520A if they decide your TFSA legally qualifies as a foreign trust.
Okay, I am officially terrified. I mean, the advice from our sources is overwhelmingly clear. If you are a U.S. citizen, completely avoid the TFSA and the FHSA.
Avoid them like the plague.
It doesn't matter how spectacular they are for your purely Canadian friends. The compliance costs totally wipe out any benefit. So if those are off limits, our listener urgently needs to know where they can safely put their money.
We need to give them the green light accounts.
Yes. Tell me there's a safe haven.
Fortunately, there is a massive safe haven built right into the system, and that is your RRSP.
Okay, here's where it gets really interesting. Because the RRSP is protected, right? It's like a diplomatic embassy.
That's a perfect analogy. The Canada-U.S. tax treaty explicitly establishes the rules here, and under that treaty, the RRSP is essentially U.S. embassy soil.
So your money is safe there.
Yes. The U.S. government explicitly recognizes the RRSP as a legitimate retirement vehicle, comparable to a 401k or an IRA.
Oh, that's a huge relief. So the growth, the dividends, all of that remains fully tax-deferred for both countries.
Completely tax-deferred.
Which means inside the RSP, I can just relax. I can act like a normal investor and buy those Canadian mutual funds and ETFs without triggering the PFIC penalties.
Exactly. Inside the protective walls of the RRSP, the PFIC rules generally do not apply. It's the one place you can invest freely, knowing the treaty shields you.
But the embassy walls only extend so far, right? The second you step outside that RRSP into a standard, non-registered taxable account, you lose that treaty protection.
Correct. Standard non-registered accounts are fully taxable by both countries.
But wait, didn't we say earlier that you can use the foreign tax credit for standard accounts?
Yes, you can. Because Canadian income tax rates are generally a bit higher than U.S. rates, the math usually works in your favor. If Canada taxes your gains at 25% and the U.S. wants 20%, you pay Canada, show the receipt to the IRS, and you owe the IRS nothing.
Because your credit covers it.
Yeah.
So the taxable account itself isn't a trap.
Right. The account is fine. The catch is what you hold inside it.
Ah, because the foreign tax credit won't save you if you trigger a PFIC.
That is the crucial distinction. If you buy a Canadian mutual fund or ETF in your standard taxable account, you're right back in the PFIC nightmare.
And the credit can't offset the punitive compounding interest of a PFC.
Exactly.
So wait, if Canadian ETFs are toxic waste outside the RRSP, but I still want a diversified portfolio in my taxable account, what do? I mean, I can't just go out and buy 500 individual stocks.
The trading fees would eat you alive.
Right. So what's the workaround here?
It requires strict discipline. The IRS does not consider an individual stock to be a PSEC. A share of Apple, Shopify, Royal Bank. These are operating businesses, not passive investment companies.
Okay, so individual stocks are safe.
Yes, and individual government or corporate bonds.
But what if I just really want the simplicity of an ETF?
Then you have to look south. You stick strictly to U.S. domiciled ETFs traded on U.S. exchanges, like the New York Stock Exchange.
Because obviously the IRS doesn't penalize a U.S. citizen for buying an American fund.
Right. You can buy them through your Canadian brokerage. You just have to manage the currency exchange into U.S. dollars.
Wow. Okay, so RRSP is your safe room. Go wild with Canadian ETFs there. But in taxable accounts, individual stocks, bonds, or U.S.-listed ETFs only, period.
That's the exact formula to keep the IRS away.
Now, understanding these rules is one thing, but let's talk about the real-world timeline. Let's say a listener is in the process of moving to the U.S. for work, or maybe marrying an American, and they are actively on the path to citizenship.
It's a very common scenario.
Right. What actually happens to their portfolio on the exact day they are officially granted U.S. citizenship?
Well, no one is going to freeze your assets overnight, but your legal relationship with the global financial system fundamentally shifts the moment you take that oath.
So what are the immediate administrative steps? Like, what is legally required?
You legally must notify your Canadian brokerage of your new status. They will require you to fill out a W-9 form to declare your U.S. personhood, and you have to provide your new U.S. Social Security number.
Hold on. Why would a purely Canadian bank care about an American tax law? Why don't they just tell the IRS to mind their own business?
Because the U.S. government plays extreme hardball. This all ties back to FACA, the Foreign Account Tax Compliance Act.
Oh, I've heard of FACA.
Yeah, in the 2010s, the IRS basically told every foreign financial institution on the planet, look, if you want access to the U.S. financial system, you must report the assets of any U.S. citizens you hold.
And if they refuse?
The U.S. threatened massive withholding taxes on all their U.S. transactions.
Oh, wow. So they practically threatened to cut them off from the global financial engine.
Exactly. And no Canadian bank can survive without the U.S. market. So your major banks, TD, RBC, BMO, Questrad, they built massive compliance departments to handle FACA. They'll report your accounts, but they generally let you stay.
That's good, at least.
But here is the risk. Some smaller fintech platforms or robo-advisors look at the massive compliance costs of reporting for just a few American clients, and they decide it's not worth the headache.
Well, if they just kick you out.
They might actually send you a letter asking you to close your account and take your money elsewhere.
That is terrible. That forces a whole portfolio liquidation at the worst possible time. If the market's down, you're locking in losses. If it's up, you're triggering massive capital gains taxes.
Which is exactly why you need a cleanup strategy well in advance. Timing is absolutely everything here.
So what's the timeline for action?
If you have a TFSA or an FHSA, the absolute best practice is to liquidate those investments and close the accounts entirely before, and I mean right before, you gain your U.S. citizenship.
Before. That is the key word.
Crucial word. While you are exclusively a Canadian resident, the IRS has absolutely no claim on those accounts. You can sell everything, take your tax-free gains exactly as Canada intended, and close it out cleanly.
But if you wait...
If you wait until after you get your citizenship, even by a single day, you suddenly owe the IRS all the Form 1040 paperwork and potentially U.S. taxes on any gains from that day forward.
Wow. So procrastination is literally the most expensive mistake a new dual citizen can make. You have to get your house in order while you're still playing by purely Canadian rules.
Shifting those non-registered investments into individual stocks or U.S. assets early will save you thousands of dollars and endless headaches.
But let's be real here for a second. A new dual citizen is staring down portfolio liquidations, FPICA compliance, dodging PFIC penalties, managing exchange rates. You can't just DIY this on a Sunday afternoon with some free tax software.
No, you really can't. Navigating FESI and cross-border tax treaties is incredibly risky to do alone. You need specialized professional infrastructure.
Because having fragmented advice is how catastrophic mistakes happen, right?
Exactly. If you have a Canadian accountant who doesn't understand IRS rules or a U.S. advisor who doesn't get Canadian tax treaties, things fall through the cracks.
Which brings us directly to the provider of today's insights, Muneris Financial Services. When we looked at their approach, the recurring theme was eliminating those exact blind spots.
Yeah, they really focus on that holistic financial architecture.
Think about it like this. You might have a standard investment guy who rightfully tells you to liquidate your FHSA before you become an American. But he doesn't realize your mortgage broker was relying on the capital in that FHSA to clear the down payment for your new home next month.
Right. The left hand doesn't know what the right hand is doing. And if we connect this to the bigger picture, having a unified team is the difference between just surviving this transition and actually thriving.
Absolutely. Muneris Financial Services is an exceptional value precisely because they consolidate that expertise. Their experienced team goes way beyond just investment advice.
They actively include licensed mortgage and real estate brokers, right?
Yes. So they offer comprehensive guidance throughout those complex transactions, like buying a home while navigating FHSA rules. And it all ties together at the top. The CEO of Muneris, Mansour, is also a qualified life insurance broker.
Which is a huge strategic advantage.
It really is. It enables clients to access expert advice across multiple financial disciplines: investments, real estate, mortgages, estate planning, and vital insurance products, all from a single trusted source.
It creates a cohesive architecture. When the person structuring your cross-border investments is fully integrated with your life insurance and real estate goals, your wealth is actually protected holistically from both Canadian and U.S. tax inefficiencies.
It's just the smartest way to play the game. So for you listening, if you want to connect with the team, you can contact Muneris Financial Services directly. Their cell is 778-898-3202. You can email the CEO at mansour@muneris.com or just visit their website at muneris.com.
Getting professional guidance before you hit these traps is paramount. It is always cheaper to build the map before you walk into the minefield.
For sure. So let's bring this all home and briefly recap the golden rules for you today. If you're on this cross-border journey, your RRSP is your best friend. The TFSA and FHSA are IRS traps. Avoid Canadian ETFs and taxable accounts, and get a professional like Muneris Financial Services to help clean up your portfolio before you take your oath.
Stick to those principles and you'll keep your compliance costs to an absolute minimum.
But before we go, I want to leave you with a final thought to mull over. We started today by picturing you as a master of your financial domain, only to have the IRS wrecking ball swing through. We live in an increasingly globalized world now, right?
Oh, without a doubt. The modern workforce is borderless.
Remote work, digital nomads, dual citizenships, these are becoming the norm. But national tax codes are still fiercely territorial.
Like applying 1980s offshore tax evasion rules to standard foreign retirement tools.
Exactly. So the question we have to ask is this: will archaic, nation-based tax policies like the PFIC rules eventually have to adapt to the 21st century?
Mhm.
Or will global citizens forever be penalized, trapped by red tape, simply for participating in the local economies where they actually live?
It's a massive tension. The collision between global mobility and national taxation is really just getting started.
Definitely something to explore on your own, and think about the next time you log in to look at your portfolio. Thank you so much for taking this deep dive with us today. We'll catch you on the next one.